The 15-year era of U.S. exceptionalism is confronting a historic breaking point. For over a decade, the winning strategy was simple: buy U.S. mega-cap tech and hold the U.S. dollar. But as we enter 2026, the global financial order is fracturing. Capital is now rotating away from crowded, expensive American stocks into deep value and high-growth markets across the globe. We are entering the Great Divergence, where international markets are finally positioned to take the lead. Welcome to Coffee Break Capital. Financial markets move fast, but we move faster. Sit down, take a sip, and let's get you caught up on the numbers that matter today. We begin with the primary threat to global portfolios: geopolitical fragmentation. Experts give this a risk score of 5 out of 5. The transition to a multipolar world means trade is no longer just about efficiency. It is now a strategic weapon. If the U.S. administration implements universal baseline tariffs, export-heavy economies like Germany, Vietnam, and Mexico could be hit hard. Any retaliatory measures from Europe or China could lead to a painful contraction in global trade volumes, hurting the very markets investors are now flocking to. There are two other major headwinds to watch. First, while the consensus expects a weaker U.S. dollar, any surprise spike in U.S. inflation could force the Federal Reserve to keep rates high. This would reignite the dollar wrecking ball, crushing emerging market debt and eroding international returns for U.S.-based investors. Second, China is currently attempting to, quote, export its way out of a domestic property slump by flooding global markets with cheap, subsidized high-tech goods like EVs and solar panels. While this helps consumers, it threatens to decimate the profit margins of industrial firms in Europe and Brazil that simply cannot compete with those prices. Now we look at why the tide is turning. The S&P 500 is currently priced for perfection, trading at a forward price-to-earnings (PE) multiple of roughly 21x. In contrast, international markets offer a massive margin of safety. Developed international markets trade in the 13x to 14x range, while some European sectors like banking and energy trade at single-digit multiples. Before we dive into the specific countries leading this charge, take a second to hit that subscribe button below. We're tracking these global shifts every week, so you don't miss the next rotation. Vanguard projects that over the next decade, U.S. equities will return only 4 to 6% annually, while international equities are expected to deliver 7 to 9%. The catalyst for 2026 is simple: mean reversion. As U.S. growth slows to its normal trend, the massive valuation spread between the U.S. and the rest of the world must narrow. The AI trade is no longer just a Silicon Valley story. While the first phase focused on U.S. software and chip designers, the second phase, the build-out, is global. The physical infrastructure for AI, including power grids and advanced materials, lives outside the U.S. This benefits semiconductor equipment makers in the Netherlands, memory chip producers in South Korea, and copper miners in Latin America. Simultaneously, the U.S. dollar's decade-long bull market appears to be exhausting. As the Fed cuts rates in 2026, the narrowing interest rate gap between the U.S. and Europe will weaken the dollar. A 10% decline in the dollar acts as a mechanical 10% boost to the returns of unhedged international stocks. Japan is the highest conviction idea for 2026 across almost all major financial institutions. The reason isn't just cheap stocks, it's a fundamental change in how companies are run. The Tokyo Stock Exchange now requires companies trading below their book value to disclose plans to improve capital efficiency. This has triggered a wave of share buybacks and dividend increases that were unthinkable a decade ago. Furthermore, Japan has finally exited its lost decades of deflation, allowing companies to regain pricing power and boosting the margins of Japanese banks as interest rates normalize. The emerging markets EM story for 2026 is dominated by the China Plus One strategy. As global companies move supply chains out of China, 3 countries are winning big: Mexico for manufacturing, Vietnam for assembly, and India for high-value services and tech. India is currently the world's best structural growth story, with earnings growth projected at 15 to 16%. Meanwhile, Vietnam is anticipating a formal upgrade to emerging market status in September 2026, which could trigger billions in automatic inflows from passive funds. Looking ahead to next week and the coming months, expect a continued acceleration of capital into Japanese equities as more corporate earnings reports highlight the impact of governance reforms. We also anticipate early front-running of the Vietnam market upgrade, as active managers move in ahead of the expected September reclassification. The Great Divergence is no longer a theory, it's a structural pivot that is now appearing in the data. The investment landscape of 2026 is about broadening your horizons beyond the Magnificent Seven. By aligning your portfolio with the structural reforms in Japan, the growth in India, and the value in Europe, you are positioning yourself for the next cycle of global leaders. This information was compiled from various sources across the internet and is not intended as financial advice. As always, make your own decision after doing research.